Beforepay is an Australian fintech company offering early wage access, also known as a pay advance. Their core proposition is to provide working individuals with an alternative to high-cost payday loans for short-term financial needs. They frequently position themselves as an ethical lender and have won multiple Ethical Lender of the Year awards. Beforepay's claim to ethical lending rests on several key features that contrast sharply with traditional predatory lending. Firstly, their flagship product, the Pay Advance, charges a fixed 5% transaction fee with no interest or late fees. This transparency means the cost is known upfront, unlike revolving debt or payday loans with high interest rates and compounding fees. For example, the maximum cost of borrowing $200 is just $10. Secondly, Beforepay's model is designed to prevent a debt spiral. Users can only take out one advance at a time, and it must be fully repaid before another is available. They use proprietary AI and machine learning to assess a customer's financial eligibility and set safe borrowing limits, often small amounts around $300 to $400, based on their income and spending habits. This internal risk assessment aims to ensure the advance is not unsuitable for the individual. They also offer free budgeting tools within the app to support financial health. Despite its self-proclaimed ethical standing, the early wage access industry, including Beforepay, faces scrutiny from consumer advocates. The main concern is that these services, while cheaper than payday loans, still charge a fee for a borrower to access money they have already earned. Critics argue that frequent, habitual use, even with a low fee, can be tantamount to a 5% pay cut on the borrowed amount, potentially trapping low-income users in a cycle of needing the service just to make it to their next payday. Furthermore, a significant regulatory blind spot exists in the broader market because many of these pay advance services are structured to avoid being classified as traditional credit or loans, thereby falling outside the scope of comprehensive consumer protection laws that mandate formal affordability checks and hardship provisions. This regulatory ambiguity raises questions about the ultimate ethical responsibility to the most vulnerable users. While Beforepay does its own risk assessment and has repayment flexibility, the underlying systemic issue of workers paying to be paid remains a point of ethical debate. Beforepay has built a model that is arguably more ethical and transparent than traditional, high-interest payday lending, evidenced by their fixed fees, no late penalties, and controls to limit debt spiraling. However, the ethical debate about earned wage access continues, focusing on the broader structural issue of fees for short-term loans and the risk of dependence for those living paycheck to paycheck. For a single-use emergency,